Good morning, members. It is the scheduled time and we have a quorum. I call to order the meeting. Item 1, meeting with the administration. We welcome the government representatives as well as the representatives from the HKMA and the SFC. Now, first of all, we will deal with the follow-up matters arising from the meeting on the 8th of July. The government has already made a written reply to the questions raised by members on the previous meeting. We will now invite the government to briefly walk us through the paper. Members who would like to speak, you may now press the button. Chairman, good morning, and good morning, members. Thank you for scrutinizing the bill together with us. At the previous meeting, members were concerned that in the bill, the value of assets under management is to be determined in the manner specified by the Commissioner of Inland Revenue. And members were concerned about the specific arrangement in terms of enforcing this mechanism. Now, briefly speaking, we have struck a balance between flexibility and certainty. We proposed that the Commissioner would announce the guidelines on the web page of the IRD. Now, this is an established mechanism. We have adopted similar arrangements in previous amendments. So this approach can allow us to swiftly update the guidelines after gauging the industry's views. Now, since this is a new arrangement, so when we first publish the guidelines, we will submit the guidelines for the panel of financial affairs scrutiny. At the previous meeting, some members also raised a question concerning the retrospective effects of the enhancement measures. It will trace back to tax assessment year 2025 to 6. Now, if some fund managers have already submitted their financial returns according to the requirements of the SFC, do they need to resubmit their financial statements? Now, on that, I will invite the Commissioner to give a brief reply, and then we will invite Ms. Grace Chan from the SFC to speak. Mr. Benjamin Chan, thank you. And concerning funds and fund managers, concerning their tax returns, now the established mechanism is for unlimited partnership and open-ended fund and corporate fund. No tax returns are required. No financial statements or reports under the SFC is required. Now, after the enhancements, there is a new reporting mechanism starting from tax assessment year 2025 and 6. Under the new arrangements, again, the aforementioned funds do not have to submit financial statements or returns under the SFC to the IRD. So concerning statements or returns already submitted to the SFC, after the bill has taken effect, there is no impact. So concerning limited partnership or limited fund or fund managers, at present, they need to submit a tax return. Now, the financial statements and profit tax return has to be submitted to the IRD. However, forms or returns required by the SFC need not be submitted to the IRD. So for the above-mentioned companies, for financial statements or returns submitted to the SFC, they do not have to adjust or resubmit the statements to us after the bill has been passed. Now, according to number 10 of the Hong Kong Accounting Standard, changes to tax legislation after returns have been submitted are non-adjusting events. So legislative amendments will not result in changes to already submitted financial statements or returns. So after the passage of this bill, funds and fund managers do not have to resubmit their financial statements or returns to the IRD. Thank you. SFC, please. Thank you, Chairman. Now, some points of supplements. The bill will only affect funds and specified and special purpose entity eligible for tax concession. It will not affect the financial situation of fund managers themselves. So licensed fund managers are not required to make amendments or resubmit the financial statements already submitted to the SFC. Now, even though the fund manager's financial situation is affected by the passage of the bill, as mentioned by the Commissioner, according to HK AS 10, licensed fund managers will not have to resubmit their approved financial statements or returns. Now, the funds are only accessible by private investors, so no reports are required by the SFC. Now, according to the practice under HKAS 10, open-ended fund companies are required to submit financial statements, including profits tax estimation. These are not required to be amended after the passage of the bill. Thank you, Grace. If there are no other questions, we will move on to the next item. We have received 6 submissions, and the government will make a consolidated written reply to those submissions later. Now, next item, we will continue the clause-by-clause scrutiny of the bill. We are now resuming scrutiny of clause 5 of the bill. That's page 12 of the markup copy in Chinese. That's in relation to the proposed amendments to Section 20AN. That's a C1630. Now, the government has already replied to the matters raised by the legal advisor. We will come to that later. Now, please remind members the relevant points to note. Members, you may now press the button when we have come to the particular clause. And we will now invite the administration to continue with the clause-by-clause scrutiny. Thank you, Chairman. We were at page 12. 20AN is about profit tax exemption for profits made by funds. Now, we will add a Schedule L, that is an excluded list, which are funds which are not eligible for exemption. Now, since we have removed the 5% hurdle rate, we will delete Section 4. Now, page 13, we are expanding the definition of control. The concerning definition by corporation, we will extend that to the entity. Next page, page 14, we are adding the definition for entity. Page 15, 20AO, certain profits of special purpose entities exempt from payment of profits tax. Now, first of all, subsection 1, we have added subsection 1B. That is, we will expand the tax concession for special purpose entity. They need not be a ratio held by the fund. So that's it. That's in alignment with the other requirements. Now we have deleted the extent of exemption, that is the percentage equal to the percentage of the fund's ownership of the special purpose entity. Now there will be no distinction between incidental transaction and eligible transaction, so we will not make distinction of the term anymore. Now page 16, subsection C, that's in relation to the deletion of the concept of incidental transaction. Our new section 2A aligns with 20 AM. We will add schedule 16L to set out revenues which are not eligible for tax concession. Now subsection 4, we are adding subsection C under the definition for interposed special purpose entity. Now, interposed special purpose entity is something between private company and special purpose entity. So we are specifying that interposed special purpose entity is an indirect beneficial interest in any assets of a class specified in Schedule 16C. Now, page 17, we are expanding the scope of special purpose entity. It includes acquisition and disposal activities. And B, Roman number 2, we are also saying that these SP can engage in other incidental activities, including acquiring, holding, and administering. Now, page 18, that's the same. We are including activity incidental to the purpose. Mr. Webster, thank you. Page 17, I would like to clarify the term. Acquiring, holding, whether directly or indirectly, administering or disposing of. Does it mean disposal? Yes, that means disposal. Please continue. Thank you. Page 19, 28P. That's in relation to 28Q as well. That is the 4 test. Now, if the funds invest in a private company, then we have to conduct certain tests to ensure that it is still eligible for profits tax exemption. So the amendments include expanding the scope from private company to entities. So we have added the category of non-incorporated entities or non-corporate private entities. Now we are limiting the 4 tests as well. So we have changed the title from company to entity, and then subsection 1A for specified securities, we are narrowing the definition. We are excluding loan stocks. Now, subsection 1B, we are also expanding the definition of entity to include non-corporate entities. Now, for part C, it's the same. We are narrowing the definition and changing company to entity. 21, the new definition is about equity interest and entity. Page 22. Now again, very similar changes about the 4 tests. This is about when a body is not holding immovable property. So we are including the same changes in 28Q. Page 24, amendments to Section 20AS. Legal advisor, please. Thank you, Chairman. Now, page 21, short-term asset. Will there be a relevant amendment to the definition? Now, under family, family-owned fund, there is an amendment, but there is not a similar amendment to the definition here. Yes, correct. The government will propose a committee stage amendment to amend the definition of short-term assets here as well, to align it with the definition under the Family Office legislation. Thank you. Legal advisor, any more questions? Now, Marco, please continue. Page 24, 20 AS. The amendments are for deleting the subsection B. As we have said, there's no distinction between incidental transaction and eligible transaction. So for subsection B and the 20 AS, this is about holding assets that are utilized to generate income. We would delete it, with the other part remaining the same. Page 25, technical amendments. We will replace the term of transaction with a management of assets or property. 26, technical amendments again. 27, 28W, interpretation of sections 20AX and 20AY. These are provisions for avoiding round-tripping. So it gives interpretation to these two sections. Now we're adding subsection 10 and 11. So the terms control and impact have been mentioned. Now 28, section 20AX, the anti-round-tripping provisions themselves. Now one is for fund and the other one is for specified special purpose entity. Now we are adding the word etc. after the topic. Now for those companies engaging in money lending business, those may not be resident companies, so we are adding the term etc. to cover them. Now, page 29 and 30, this is the new anti-round-tripping provision. Now it will cover financial institution, insurance company, or a money lender, as well as a company engaging in intra-group financing. Now, if these entities generate income from investments in funds, then we will see whether these entities hold a 20% or above beneficial interest in the fund, whether they are associates or related persons, and whether they have substantial impact on the fund. If so, they would trigger the anti-round-tripping provision. Now, the 20% requirement is placed under 4B or 4B. So in subsection 4B, the calculation method for the 20% is explained. For example, including the profits held under a partnership. Now, in terms of life insurance, under section 23(1)(a), the holding is calculated as 5% of the premium, so the income from investment is not included in the assessable profits of insurance company. So we will not include the income from life insurance business in the anti-round-tripping provision. So that's 4D. If that is the case, only other income would be included. That's 4D as well. The provision will be triggered anyway.
Page 32. Most of the amendments are replacing the word resident with someone. We're adding new section 8A. to the effect that we're going to put in place exclusion. Say, for example, if the person is a natural person, B, if the person is a fund exempt from the payment of tax under Section 28, N, and C, if the person would not have been chargeable to tax in respect of profits derived from assets of a class specified in Schedule 16C, or if they're in the life insurance business, then they will be excluded. Page 33, subsection D. That sets out different combinations of entities. If the person holds a fund through the entity, then they will also be excluded. 8B. In the general course of business, we may not invoke the anti-round-tripping provisions under specific circumstances. This is such that it will not invoke when the business closes down. Page 34, we are amending subsection 9. We're replacing the word resident with a person. 9A, this is a new subsection. This is to avoid double taxation. That is, if a person holds a fund, and this is to avoid assessing both the profits of a fund and the income of a person as tax chargeable. 9B, this is the theme. If the fund has its value increased, then we may also assess their profits. Page 36 about definitions of insurance companies, loan money lenders. Page 37, that's similar to 28AN. That's about assessable profits of special purpose entities. We're not going to repeat the same amendments. If, for example, we are adding the word etc. Page 38. Regarding sections 2A, they correspond to our arrangement that the SPE will be enjoying tax exemptions despite the holdings. But as a safeguard, we're going to apply the general anti-round-tripping provisions that apply to fund to also SPE. That's why we have this new 2A to 2B. They correspond to 28X, section 1 to 4. So these are some similar provisions. I'm not going to go over them again. Page 41. We are referencing some new clauses. 3A, it's about specific anti-round-tripping provisions on money lending to regulate financial institution, insurance company, or money lenders. These are very much similar to the previous provisions. Now we move on to page 44. We replace again in subsection 4 the word resident with a person. Subsection 5A, this is new. It is said that the extent of a person's beneficial interest in a special purpose entity is to determine in accordance with Schedule 15D. And then the other amendments are about changing the word resident to a person. Now, page 45, new subsection 7A. It's also about exclusion. We are expanding the exclusion list. That's similar to section 20AY. We're adding the natural person that is a fund exempt from payment, so on and so forth. We're going to include that in the exclusion list in section AY. 7B, 7C, as mentioned earlier, if a fund is winding down, we put these clauses in place such that we will not invoke the anti-round-tripping provisions, as long as the commissioner is of the opinion that the person would not have benefited. Page 47, we're going to replace the resident with with a person. Subsection 8A. This is also to avoid double charging of tax. We're not going to tax a person for his income and also the ownership of SPE. Page 49. We are going to include definitions of insurance company, loan, money lender. Section 20AZ. All these are about a new simple reporting requirements for funds. We're going to explain how it works. First of all, we're going to define what designated fund means. Page 50. B. If a person is responsible for the management of the fund, then they will be the specified person. We're also going to define annual notification, designated system, initial notification. Subsection 3. If a fund fulfills certain conditions, then the requirement of submission of annual notification or initial notification will not apply. That is, if a fund is chargeable to profit tax, if they are required to furnish a return, if it's a limited partnership fund or open-ended fund company, they will not be asked to submit annual notification. If a specified fund is a limited partnership fund or open-ended fund company, and if they does not have any accessible profits, then they may make an election in writing to that sections 20AZA or 20AZB apply to specified persons of the fund for that year of assessment. Subsections 5 and 6 are to the same effect. Page 52, 20AZA. That's about how we initial notification is to be submitted. A specified person of a specified fund must file a written notice in respect of the fund with the commissioner within a period of 6 months beginning on the date that it begins to manage the fund. Subsection 2, it says that the specified person is not required to file it under subsection 1 if the condition in subsection 8 is met. Mr. Rock Chen. Thank you, Chairman. In subsection 1, it is said that the person needs to submit it when they start managing the fund. I wonder if that means on the day when the contract starts to take effect, because we have to have a date. You need to count 6 months after that. Benjamin, please. The member's understanding is correct. When a person is engaged as a fund manager, starting from that date, if the contracts take effect on that day, then they will need to submit it within 6 months. Sometimes the date of signing the agreement may be different from the effective date. That's true. Well, subsection 3, it says a specified fund may designate a specified person of the fund in Hong Kong for the purposes of this section. Subsection 4. It says when the designated person is assigned, then that person must file a written notice within 6 months. Subsection 5, under certain circumstances, the person is not required to file the initial notification. That is, if the fund already submit the notification, then the person does not have to submit it. B, if at the time before the expiry of the period mentioned in the subsection, the designated person files a notification in respect of other fund. Subsection 6 says that if a person ceases to be a designated person, then the other specified person needs to submit the notification. Subsection 7. It says how under what circumstances the specified person is not required to file the notification. That is, if other persons already submit the notification. Subsection 8. Under what circumstances would the person is not required to submit a notification anymore? A, that is, if the specified person of a specified fund files a notification in respect of other specified fund. B, all of the following event occurs. Say, for example, if, according to subsection 3, at any time before the expiry of the period, the specified fund designates any other specified person of the fund. Second, if other specified persons already filed the initial notification or if they are not required to file the notification. 3. Page 54. On the expiry of the period, the designation is in effect. New subsections 9 and 10. They're about a grace period. That is after the bill takes effect. The arrangement will apply to the assessment period between 1st of April 2025-26. We're going to give them a 12-month grace period. Subsection 10 about some exemptions, conditions. Subsection 11, it is said that the notification must be filed in an electronic record and that is sent by a designated system and contains all information. Section 20 AZB, that's about the requirement for annual notification. It is said that an assessor may give a written notice to a specified person of a specified fund for a year of assessment, requiring the person within the time stated in the notice to file another written notice in respect of the fund for that year of assessment. That's the annual notification. Second, the requirement for annual notification. Again, it needs to be sent by using the designated system and need to contain all the information specified by the Board of Inland Revenue. So Section 20 AZC, that's about the designated system. The Commissioner may designate any system for communication with the Commissioner, and there will be some specified requirements. The way of generating or sending an electronic record, the digital signature, so on and so forth. Page 56. Subsection 3. The Commissioner may either generally or in a particular case accept an initial notification or annual notification despite a requirement not being complied with. Subsection 4. A notice is not a subsidiary legislation. Mr. Robert Lee. Thank you. I'd like to follow up on page 56 of the marked up copy. It's about the requirement of a designated system on keeping of records. There is 20 AZD bracket 2B. It says that the person must retain the records for a period of no less than 7 years after the end of year of assessment within which the initial notification or annual notification is filed. So if a fund within 3 years already wind up or disassociate, does the specified person have a personal responsibility to keep all the records for 7 years? For securities or other regulatory requirements, is the treatment the same for funds under this ordinance? Thank you. Benjamin, please. For crypto asset reporting framework or AOEI, the arrangement is slightly different here. We act in accordance with the existing IRO on business records. That is, if a company already closes down, then they will not be required to keep all these records. So there is a slight difference in terms of treatment, yes. Marco, please continue. I'll carry on with page 57, 20 AZD on records to be kept. Subsection 1, sections 51C applies with the modification specified in subsection 2. The specified persons must keep sufficient records to enable the accuracy and completeness of an initial notification or annual notification, and they need to retain the records for 7 years. Subsection 3 is that Section 80 applies to a failure to comply with Section 51C as modified by subsection 2 in the same way Section 80 applies to a failure to comply with Section 51C. Page 57. That's new Section 20AZE about engagement of service provider. It is said that a service provider may be engaged for or on behalf of a specified person to submit these notifications. Despite that, to avoid doubt, even if a service provider has been engaged, the specified person is not relieved from their obligations to file a notification. Page 58, that's about a technical amendment. Section 18(4)(e) is about the concessionary tax regime. We include Section 4(2)(c) for the Secretary for Financial Services and Treasury to amend by Gazette. Section 40AV. These are some corresponding amendments. Schedule 16E is the tax treatment of family-owned investment holding vehicle and family-owned special purpose entity. Subsection 2 and 3, we are amending some reference because Schedule 16I will be abolished. We are adding a new Schedule 16L. That's why we are changing the reference. We add a new subsection 4. Because subsections 2 and 3 are about the future, subsection 4 is about what used to apply. Page 60. Section 51C about business records to be kept. We're adding subsection 5 bracket AAB is that Section 20 AZD can modify the relevant subsection. Section 80, penalties for failure to make returns, make incorrect returns, etc. We are adding some corresponding reference because we are amending also Schedule 16D. We are adding some new subsections. They are 2ZF. It says a person who without reasonable excuse fail to file the notifications, then they will commit an offense and is liable on a conviction to a fine at level 3. New 2ZG says for subsection 2ZF, engaging a service provider under Section 20 AZE does not in itself constitute a reasonable excuse. Subsection 2ZH. If a person is convicted of an offense for failing to do an act, the court may order the person to do an act within time specified in the order. Subsection 2ZI. A person who fails to comply with an order of the court commits an offense and is liable to a fine of level 4. Page 62. We are adding this new Section 80Y that's about offenses of service provider in relation to filing written notice. Subsection 1, this section applies to a service provider who is engaged by a specified person or a specified fund. Subsection 2, if the service provider fails to cause a written notice to be filed, then they commit an offense and is liable on a conviction to a fine at level 3. In a reply to the ASST of the LegCo, we said that we're going to include the phrase without a reasonable excuse. That is, the service provider may provide a reasonable excuse to explain why they failed to cause a written notice to be filed. That's consistent with 20AZ. We are also adding some new definitions. Mr. Rapster, thank you. I'd like to clarify Section 80Y. On e-tax, we include some similar provisions for service providers. Are we making reference to the relevant arrangement? Is the practice consistent? What about the penalty and liability? Benjamin. Thank you. That's correct. We have made reference to the penalty against service providers on e-tax returns. Thank you. Thank you. Page 63. Under Section 89, we add subsection 35. That's about the transitional arrangement. It says we refer to Schedule 68.
C.
Page 64, Schedules 15C. In relation to 20AX, about anti-round tripping provision for funds. And if this is triggered, how should the amount of assessable profits be ascertained? So in 20AX, we made changes. For example, we changed the resident to natural person. That applies to here as well. Page 65, new section 3 of Schedule 15C, which relates to calculating the share of the person's beneficial interest, and that certain situations should be excluded. Now, such as the exempted person. For exempted person, we refer to, for example, a life insurance company. The investment profit is not included in the calculation of assessable profits. So if this involves a life insurance company, then it will not be included. The same goes for pages 66, 67, and then 68, 69 relates to the triggering of another anti-round tripping provision 20AY in Schedule 15D in relation to ascertaining the amount of assessable profits. We change the word resident to a person. And then page 70, new 2A. Now, if this person holds beneficial interest of a fund that triggers the anti-round tripping provision, then we need to consider the exempted persons, as mentioned, such as the life insurance company. Such beneficial interest should not be included. And then 2B relates to another scenario. That is, for the anti-round tripping provision applicable to a fund, we're going to apply that to the SPE. So for 20AY and all the 2A, 2D, and 3A subsections, these are relevant. So we're talking about a situation of co-investor of an SPE. So for the co-investors in 2B, there should be adaptation of the original formula. For example, there is the variable B1 in relation to the share of holding of beneficial interest of a person. Now, if it doesn't involve holding of a fund, then it will be removed, and there will also be modifications in relation to variable B2. In relation to a co-investor situation. For 2C, again, for indirect holding of beneficial interest by a person, exempted person, it will be excluded as well. 2E, a definition of exempted person. Page 73, amendments to Schedule 16C. This applies to specified assets under the UFR as well as the FIHVs and the relevant tax exemptions. So this schedule relates to the classes of assets specified. We're going to add a number of things to 1A, insurance-linked securities, 2A, direct indirect equity interest in an entity that is not a corporation. Page 74, 8A, precious metals at a value not exceeding 20% of the investment portfolio. 10A, another new class in relation to commodities. Mr. Robert Lee. Thank you, Chair. Here is my question. C1730 or marked up copy, page 74, 8A. precious metals at the value not exceeding 20% of the investment portfolio during the basis period of a year of assessment. So about this cap of 20%, I'd like to know more about this formula. Does it refer to the cap of 20% at any time during the basis period of a year of assessment, or just the average? Or are you referring to the snapshot figure at a particular point of time? So can you elucidate the 20% cap, Benjamin? Now we calculate the amount on a monthly basis. At the end of each month, we consider the portion of, or the value of the assets of precious metals in the investment portfolio of the whole fund, and we check that value, and then we divide it by 12 months. So for the denominator, we're talking about the investment portfolio as a whole. And then we consider the total aggregate value at the end of the year of assessment, and we calculate the percentage. So I stand to be corrected, but when we look at the value of the precious metals, it seems that the value is considered on a monthly basis. So there'll be 12 figures. For the investment portfolio, we're looking at just one aggregate value. And then you do the calculation to consider the 20% cap throughout the year. Marco, please continue. 10A. Specified commodities. They should be in connection with and incidental to the trading of OTC derivative products. The trade volume should not exceed 15% of the total trade volume of the commodities and the OTC derivative products of future contracts traded during the year of assessment. So we're talking about commodities relating to the trading of OTC derivatives. And then new sections 12 loans, 13 immovable property outside Hong Kong, 14 digital assets, 15 emission allowance, 16 emission derivatives, 17 carbon credits. And then page 75, some definitions under part 2 of the schedule. B1, we're going to relax the scope of the definition of futures contract. That means contract that is listed or traded on any stock exchange or futures exchange. 76, we also add the number of new definitions such as commodity and other definitions. Now, we also refer to part 2 of the relevant legislation. Page 77, emission allowance. We draw reference from the definition provided by an international organization. For example, the instrument should involve conveyance of a right to emit greenhouse gases, and that it should be traded on a trading platform for climate-related products recognized by the Secretary for Financial Services and the Treasury. Emission derivative means a derivative that payoffs of which are wholly or substantially linked to the payoffs or performance of the underlying emission allowance or carbon credit. Precious metal. It means gold, silver, platinum, iridium, osmium, palladium, etc. in a manufactured or unmanufactured state. We've made reference to the AML of ordinance. Now here it also says, except any exchange-traded commodity. That is because in Part 1, Section 8, we also refer to commodities being traded, and these are eligible transactions, not subject to the 20% cap. So for the trading of commodities, they don't fall within the definition of precious metal. So it's broader in scope. We also have the interest of, the definitions of entity and loans, which are already covered. For carbon credit, it means an instrument that represents the reduction, removal, or avoidance of greenhouse gases and is traded on a trading platform recognized. Again, we've made reference to the definition provided by international organizations. Next, digital asset. You will find the subsections A, B, C here. First, it should be a virtual asset as defined by the Anti-Money Laundering and Counter-Terrorist Financing Ordinance, specifically Section 53 ZRA bracket 1. That is value in a cryptocurrency. And then B, a digital representation of value that is excluded from the definition in Section 53 ZRA2AI. The exemptions include central bank or digital assets issued by central banks or sovereign bonds of government organizations. C, we also provide some exclusions. If it's cryptographically secure digital representation of value that provides its holder an interest in 16C, then it will be excluded. Page 78. Two new sections, including the definitions of carbon credit emission allowance. It refers to the trading platforms recognized by the Secretary for Financial Services and Treasury. As for the 20% cap, that will be calculated in a manner specified by the Commissioner, as explained by the Commissioner just now. Page 79, Schedule 16D, provisions relating to carried interest and its tax treatment, and the relevant amendments. We are going to delete the part about certified investment fund. Instead, we'll put in place the word fund. Page 80, the same goes for certified investment fund and the reference, and then investment management services. There is a textual amendment. And then associated corporation, this part will be repealed. We're going to provide a closely related entity definition because we're referring to the associated entities such as corporation and entities. Now we've broadened the scope called closely related entity. This is a broadening of the definition of associated corporation. Page 81. Control. Not in relation to the control between a corporation and an entity, but rather two entities. Certified investment fund. This is to be repealed, to be replaced by the definition of fund, and there is also a definition for the word entity. Page 82. Section 2. Qualifying payer and its meaning. Again, we've made an amendment. It will be replaced. The word fund will replace certified investment fund, and associated corporation will be replaced by closely related entity. We've also added the definition of fund and deleted the meaning of certified investment fund, and then new to a meaning of closely related entity. Page 83. Section 3. Meaning of eligible carried interest. Subsection 1. You'll find A and B under subsection 1. First, qualifying person, meaning the fund manager. It should hold a specified interest from a qualifying person, usually the fund company. 1B, qualifying person and also qualifying employee of, say, the fund or specified entity. So we put in place some requirements. For 1A and B, there is a distinction. The fund management company or the employee may receive an amount that is regarded as eligible carried interest. And then one capital A. The new concept of specified interest, page 84. For the specified interest, the qualifying person or the qualifying employee is entitled to receive the share of the profits. And then B, for the entitlement, it's determined in accordance with an agreement governing the operation of fund or entity. And then B2 is not attributable to the capital contribution of the person or employee to the fund. And B3 is not discretionary but may allow a degree of flexibility concerning the amount, timing, manner, or payment, or otherwise, or distribution of the share of profits. On the whole, it should not be discretionary. Page 85, subsection 2, and the amendments. Take a look at the downward arrow about operation. That is referring to 1A, B2, B1. And then for the up arrow, it refers to qualifying person or qualifying employee receiving the return. And then 2A, we have repealed the reference to the hurdle rate to provide tax certainty, as explained in our electrical brief. This is an enhancement measure. According to the industry's feedback, the hurdle rate should not be referred to. Page 86. There are amendments specifying the person being a qualifying person or qualifying employee. So you'll find a number of amendments relating to this concept, except 4A. This is a new section about the assessment of risk, referring to subsection 4B. There was no significant risk that at least a certain amount of the sum would not be received. So for 4 capital A, it refers to risk assessment. We'll have regard to the circumstances of the case in relation to the minimum amount to be received or accrued to a qualifying person or qualifying employee, as well as the investment volatility of the fund or the specified entity. The other amendments refer to the amendment to qualifying person or qualifying employee. Page 87, a textual amendment. Again, to make a clear reference to qualifying person. 6A refers to subsection 6. That is, in respect of a qualifying employee, how the risk should be assessed and the time frame. So this is a similar amendment. And then there is also another amendment on qualifying person. Page 88, again, amendments to the word person to a qualifying person or qualifying employee, and another amendment to references to the different subsections. Page 89, no amendment. Page 90, about the profits tax concessions for, and then 2C, under profits tax treatment of eligible carried interest. Now, the eligible carried interest should arise from the profit of certain investment activities. This is rewritten. For C3, we've expanded the scope. Originally, it covers private equity investment. Now it covers different investments, basically profits that is exempt from the payment of tax under the UFR. And then C2, profits that are not chargeable to tax or for reasons other than exemption above, such as offshore investment, and also 3.
Page 91. The amendment is similar to the previous one. So subsection D has been deleted together with subsection C to expand the scope. 3BC concerning the definition of qualifying persons, we've expanded the definition. Now under the UFR, in the previous meeting, we said that the UFR covers certain new types of funds, for example, endowment funds and pension funds and so on. So because of the special characteristics of these funds, investment services provided for these funds will render a person a qualified person. Page 92, again deleting the word certified investment. The same for page 93. Now, section 8 is about the employees of the fund, that is the fund managers. This is the salaries tax concessions for qualifying employee. Subsection 2A. Now, for the purpose of this session, income of the qualifying employee should be paid directly by the qualifying payer. So the payments no longer has to be made through the fund company. Mr. Webster, thank you. Concerning the salaries tax concessions for qualifying employee in section 8. Now this is mentioned by some stakeholders in their submissions. So do qualifying employees include employees who have already left Hong Kong? So these employees have already paid taxes accrued for the income accrued from the company, but now the employees have left Hong Kong. So they should be able to make a claim for the tax paid. So does the term qualifying employee cover this group of people? Benjamin. Now the amendment applies to the tax assessment year 2025 and 6. So when the bill was gazetted, we made it clear on our website at the same time that despite that the bill has not been passed yet, taxpayers may apply for a tax concession if they are eligible to the concessions mentioned in the bill. Now, concerning employees who have already left Hong Kong earlier on, and tax assessment has been conducted already, and tax has been paid, after the passage of the bill, these employees can make a request to the IRD for claiming back the tax paid. Thank you. Marco, please. Thank you. Page 94, subsection 3. We have changed the formula. Now, instead of C, it has become C plus D. So it is now brackets C plus D times E. So we are breaking down C into C and D. So C means eligible carried interest received by qualifying person, and D means the eligible carried interest received by qualifying employee. So E is the same as the original D. Page 95. We have amended the definition of the qualifying employee. So eligible carried interest is no longer required to be paid by a qualifying payer. So we have changed the definition of the term qualifying employee accordingly. 96, new section 9A, related tax treatments for receipts of eligible carried interest by entity for and on behalf of qualifying employee. So this is in consideration of the actual situation of distribution of carried interest. So sometimes qualifying entity would receive the interest on behalf of the employee. So for these cases, we would deem that the receipt was made by the qualifying employees. Mr. Webster Ng, I would like to return to the formula on page 94. Now, sometimes in a fund manager may manage several funds simultaneously, or there may be several managers managing the same fund. So let's say there is one fund which is very profitable, but another fund suffers a loss even larger than the profits made by the first fund. But these two funds are managed by the same manager. So under the formula, if the loss is greater than the profit gained, then would it render the recipients not eligible for the tax concession? Benjamin, I think this is not a question in relation to the formula, but rather the definition of eligible carried interest. Under what circumstances the carried interest is eligible for tax concession? Now, there is one condition. We have specified clearly in the bill that the eligible carried interest might be accrued from income arising from investments of the fund, or a certain investment of the fund. So it means that it does not mean it is not necessary that the fund is making a profit as a whole. In particular, hedge fund. So for a hedge fund, there are several investment strategies under the same fund. There are different portfolio managers managing the same fund. So they would make investments according to their own strategies. So like Mr. Webster said, a portfolio manager may be very successful and is making a lot of profits, but the other portfolio manager is suffering from a loss. So overall speaking, the fund may not be making a profit. But still, the profit-making portfolio manager would receive carried interest. So in that circumstances, those carried interests are eligible for tax concession. Thank you. Thank you, Benjamin. Marco, please continue. Thank you. Page 97, Section 10, Obligations of Qualifying Person, Information and Records. So a qualifying person, that usually means fund companies. We have relaxed the requirements so that the carried interest may not be paid through the qualifying payer. So a qualifying person may make these payments directly to the qualifying employee. So we are amending Section 10 to reflect this change. Subsection 1, a qualifying person must take reasonable steps to ascertain whether eligible carried interest is or will be received by or accrued to a qualifying employee of the person or of a closely related entity of the person as a result of the provision of investment management services. Subsection 2, Part 9 and Section 80 apply with the modifications specified in this section to a qualifying person if certain conditions are fulfilled. For example, the person makes a claim to the commissioner concerning the eligible carried interest received, or B, a qualifying employee of the person makes a claim to the commissioner. If that's the case, then the reporting requirements would be imposed on the qualifying person. Now, subsection 3, page 98 of the markup copy. A qualifying person to whom Part 9 and Section 80 apply, pursuant to subsection 2, that is, the requirement is placed on the qualifying person, then the qualifying person must provide the following information to the Commissioner in the manner specified. Page 99. Subsection B. Subject to subsection 4, Ms. Christine Fong. Thank you, Chairman. Page 98. Concerning submission of application of claim to the Commissioner. So will there be templates provided to the applicants after the bill is passed? Benjamin. Thank you. Concerning claims for profits tax concession. In submitting the tax return, the taxpayer would have to submit the financial account as well as the profits tax calculation form as well. So in that form, the taxpayer should exclude the eligible carried interest and submit the net amounts to us for profits tax assessment. Now for salaries tax, again, employees can also make a claim. Now for salaries tax return, there is not a profits tax calculation form, so we will provide another form for the taxpayer to fill to report the amount of eligible carried interest and also the name of the fund companies or fund manager distributing the interest. Thank you, Benjamin. Marco, please continue. Thank you. Pages 98 to 99, subsection 3AB. This is about the kind of information to be submitted by the qualifying person to the Commissioner. Subsection 4. Now, if the Commissioner is satisfied that the information has been provided by the qualifying person or payer, then the qualifying person is not required to provide the information. Now, subsection 5, for the purposes of section 51C, that's in relation to keeping of records. Ms. Christine Fong, question. Please continue. Now, page 100. A qualifying person must, if eligible carried interest received by a qualifying employee is paid out of the eligible carried interest received by the person, then the person has to keep sufficient records so that after the receipt of the eligible carried interest, the record is kept for 7 years' time. B. If the interest is received by other form, for example, by direct payment, then the qualifying person must also keep records of the information under subsection 3B for a period of 7 years. Subsection 6. Now, Section 80 is about the penalties. Section 80 will apply to a failure to comply with Section 51C as modified by subsection 5 in the same way Section 80 applies to a failure to comply with Section 51C. Page 101. Obligations of qualifying payer, information and records. Now, for the term qualifying payer, it usually means the fund itself. So subsection 1 refers to the conditions where the section applies to a qualifying payer. So we have just amended subsection A. Subsection B is essentially the same. Now, the amended subsection A refers to the conditions under which the qualifying payer has to provide information and records. That's when a claim is made by a qualifying person or a qualified employee. If tax concession is claimed by either a qualifying person or a qualifying employee, then the qualifying payer has the duty to keep records. 102, relevant amendments to subsection 4. We are just separating the two types of claim, that is, claim for tax concession for profits tax and salaries tax. 103, section 12, we've deleted the requirements that the HAMA has to verify the type of the investment fund. Pages 104 and 105, the same. Mr. Rockchen. Thank you, Chairman. I want to ask Marco, page 104, 13, subsection 3. An arrangement to disguise as eligible carried interest. Now, for example, if the standard service charge is at 20%, is 2%, and the carried interest is 20%. In reality, some clients may say they want to adjust the ratio to, say, 1 and 25. So the additional 5% of carried interest, would that be deemed as a disguise to become eligible carried interest, since there is a reduction in the management fee and addition in carried interest? So this is a common practice in the industry. So for my example, the 5% additional carried interest, would that be deemed as a disguised eligible carried interest? Benjamin. Thank you, Chairman. So this is an anti-round-tripping provision. So in considering whether we will apply this provision, we would consider the entire situation. So when considering whether the anti-round-tripping provision applies, we will first consider why such an arrangement is made, and also whether this arrangement is reasonable within the business community. So if the arrangement is made on the client's request to amend the originally agreed reward rate, then it must trigger the anti-round-tripping provision. That's not the case. We will look at all the facts that contribute to such an arrangement, and also whether this is a common practice in other fund management contracts. These will be considered before we consider to trigger the anti-round-tripping provision. Marco. Thank you. Page 105. Definition for associated loss. So the amendment is to change the term arising from a transaction to arising from any profits. Since we have relaxed the sources of eligible carried interest, so we are changing the definition as well. Page 106. Concerning the application of the schedule under section 15, we are adding subsection 4 that this section is subject to other provisions of this part. And we are adding the new section 16. That's about the application scope of the bill. That the bill applies to eligible carried interest received by a qualifying person after the tax assessment year 2025 and 6. Now, for avoidance of doubt, the amended schedule does not apply to eligible carried interest received before the 1st of April 2025, but falling within the basis period for a year of assessment commencing on or after the date, or eligible carried interest accrued to a qualifying employee before the 1st of April 2025, but received by the employee on or after that date. Those interests will not be covered. Subsection 3, for any year of assessment mentioned in subsection 1, the amended schedule applies to eligible carried interest received by a qualifying person in the period beginning on the 1st of April 2025 and ending on the day immediately before the commencement date, as the amended schedule applies to eligible carried interest received or accrued after that period. So that is to provide certainty for taxpayers. Even if the bill comes into effect later than expected, there will be no change. And then we are adding the relevant definitions under subsection 4. Page 108, we are now entering amendments to Schedule 16E. Schedule 16E is about tax treatment of FIHV. So the preferential tax regime for FIHV is highly similar to the UFR tax concession system. So 20AM to 20AY, the existing provisions, these are very similar. So the amendments to the two tax regime are very similar. So again, the following amendments will be very similar to the previous amendments. So I will be very brief.
109頁，咁就我哋
Page 109, we are adding the definition of equity interest. Because in the coming reporting regime, we have also included this. That corresponds to Schedule 16C. We have included the concept of non-corporate entity. That's why we also include this definition of equity interest to the schedule. Page 110, Section 6, meaning a family-owned special purpose entity and the interposed family-owned special purpose entity. That's the same as the amendment to the non-corporate entity that cover the acquisition, holding, administering, or disposing of the assets of these FIHV and IFSPE. That also include investee private companies. Under 1AB, we include any Schedule 16C assets. That is non-corporate entities assets. We want to cover all these elements. Also, in Roman number 2, it says for the purpose mentioned is subparagraph 1 and for carrying out an activity incidental to that purpose. Subsection C, that's the corresponding practice. We are covering the activities that can not be carried out. Page 111, that's about the definition of IFSPE. Mr. Robert Lee, thank you, Chairman. And page 111 of the marked up copy, well, the administration talk about the tax treatment of FSPE to it is extended to include acquiring, holding, administrating, or disposing of Schedule 16 assets and the activity incidental to that purpose. By incidental activity, are we talking about FSPE hedging the risks by making use of derivatives or exchanging currencies? There is a ceiling of 5% for these FSPE. Exceeding that, a 16.5% of tax rate will be charged against these activities. So are we talking about the incidental activity exceeding the 5% threshold? Are we talking about activities for the purpose of hedging? Are they restricted by this 5% limitation? Benjamin, please. This is about how the entity can engage in incidental activity. It's not about whether the entity should be held by a family or the threshold. The threshold has not been changed. We're just expanding the scope of the activity which include acquiring, holding, administering some of the assets. That also cover incidental activity. According to our understanding, incidental activity refers to the assets to be acquired by the FSPE, and in the process, they may need to finance it. For the transactions of assets, if the FSPE does not have enough money, they may need to engage service providers to engage in certain activity, and this kind of activity will be deemed incidental activity. That was not set out in the original ordinance, and whether they can be engaged. Now, in the proposed bill, we cover incidental activity, and that's the purpose. Can I give you another example? For acquisition of assets in the course, if financing is involved, if the entity needs to take out guaranteed loan, by expanding the scope of activity, then the act of hedging will be considered incidental activity. And if revenue or profits is generated by that activity, then that activity will not be considered incidental activity. Am I right? For acquisition and merger, they may take out guaranteed loans, and if they need to exchange currencies to acquire assets, and if profits is generated in the course, then this kind of activity will not be subject to the 5% ceiling for the FSPE. Am I right? Benjamin, please. Thank you, Chairman. As I just clarified, this amendment has to do with what activities an entity can engage in. As I said, activity cover acquiring, holding, administering, or disposing, managing the assets. These activities are allowed. We also cover incidental activity. In light of the set activities, such as acquiring, holding assets, if they want to, say, sell an asset, and if they need to engage in incidental activity or transactions, then they are allowed. Such activity will be allowed. We don't set a threshold for this kind of activity. By incidental activity, we mean the activity incidental to acquiring, holding, administering, or disposing assets. If the entity fulfill these conditions, then the activity carried out for the set purposes will be considered incidental activity. Ms. Christine Fong. Thank you. I have a question for the Commissioner. For incidental activity, well, say, for example, some fund are charitable fund. They may invest in films, and they may be able to generate profit from that. Some of them invest in community living room. Do these activities enjoy tax exemption or concession under the regime? Thank you for the question. We are at the family office and FSPE. We already covered fund just now. Ms. Fong asked what assets the entity can invest in. If a company invests in films, for example, they are allowed. Well, for FIHV, for funds, they should not operate any business on their own, and that's set out in the ordinance. But they can invest in some other companies. If those companies engage in film business, then that's allowed, because those companies will have to pay taxes. The fund or the FIHV cannot run such a business, but they can invest in companies that does such a kind of a business. Page 111. we are expanding the definition of IFSPE. Subsection 3 and 4 sets FSPE is something between family-owned special purpose entity and a private company. Subsection 5, it is said that if a FSPE has an indirect beneficial interest in any Schedule 16C assets through an interposed entity, then they have a beneficial interest. Page 112, profit tax concession for FIHV. That's similar to the amendment to the common tax regime. We no longer reference the difference between eligible qualifying transactions and incidental transactions. Subsection 3, the assessable profits are profits derived from Schedule 16C assets, but do not include income specified in Schedule 16L. Subsection 4B. We rewrite the entire subparagraph. We no longer mention qualifying transactions, but asset management. Page 113, we are deleting the entire subsection 5 because the qualifying transactions are no longer subject to the 5% limitation. Page 114, exception. It's about a net asset value rule, while we change it to asset value rule. Under FIHV, it is said that the family office have to hold asset under management of at least $240 million. We changing to the NAV rule to asset value rule. We have mentioned it in the electrical brief. We are relaxing the requirements because we want to also cover persons participating in granting loans. Page 116, we are amending NAV rule to asset value rule. The same goes for the amendments that follow. We are amending subsection 10 because we are going to delete and remove Schedule 16I. Now we're at page 119. That correspond to the common tax concession regime for fund. That is 20 AP. That is, if a fund holds a private company, they need to go through the 4 tests. We have a similar provisions here. It talks about how FIHV holds a private company. We narrow down the definition of holding a private company. We cover not just investment in private company, but also other immovable property and so on. The rest are similar amendments. We changed the word private company to relevant entity. Now we move on to page 123, section 13. That's about the 4 tests too. That correspond to private company and relevant entity. If the FIHV does not hold immovable property, then this section will apply. That's similar to section 20AQ. The rest are the same. Let's move on to page 125, section 15. We repeal earned from the transactions specified in section 9, bracket 3 of the schedule, and we substitute it with derived from Schedule 16C assets or the management of Schedule 16C assets. Page 126. That's about profit tax concession for FSPE. Under the common tax concession regime, section 28O, this amendment is similar to that. Subsection 1. We are including this B because there is a similar tax concessions for FSPE. They are no longer limited to the percentage. Any persons making the capital contribution will enjoy the exemption. This B is to reflect the repeal of the day-to-day control limitation. Page 129. We are referencing the profits. We are amending subsection 3, repeal it. We no longer mention the qualifying or relevant transactions. We are adding also B, which says does not include income specified in Schedule 16L. Page 128, we're appealing the relevant reference to the 5% threshold of qualifying or incidental transactions. Page 129. This is also about the 4 tests. This is about FSPE. So the highly similar to the relevant provisions earlier on about the FIHV. For a profit company, we also include the relevant entity. For the specified securities, we cover also shares, stocks of another private company, and equity interest. Now coming to page 133, it's about short-term assets. We already covered that. We are going to make a corresponding amendment to the definition of short-term asset. In the principal ordinance, we have already made the similar amendment. We are adding this definition of subject equity interest because we have used this term here. Now, page 134, similar to the earlier parts, the 4 tests on FSPE. This time, it applies to FSPE not holding immovable property. I've already covered the similar amendments. Now we move on to page 137. Loss or profits incurred by FSPE. We just replace the term earned from the transactions with derived from the property and the management of the property. Page 138. They are about accessible profits of resident persons. This is an anti-round tripping provision. That is section 20. That's highly similar to section 28X of the common tax concession regime for funds. We are adding the word etc. after resident persons because in the anti-round tripping provisions, it applies to insurance companies, money lenders. They may not be Hong Kong resident. That's why we add etc. after the word resident persons. In section 20, we are adding the definition of insurance companies, loans, money lender. Page 139. We're defining what control and significant influence mean. Page 140. Section 21. That's the meaning of associate. We are changing the reference to sections 20 and 23 because we have more provisions talking about associate. So we're just changing the reference. Now we move on to page 143, section 22. This is the anti-round tripping provision. This corresponds to section 28X, to the relevant tax concession regimes for a fund. We're adding etc. after resident persons. Subsection 5A. That's the specified anti-round tripping provisions that apply to insurance companies, financial institution, money lenders. They hold 20% of the beneficial interest. Then bracket A, bracket 1, 5B, then they will be able to enjoy the tax concession. If the FIHV holds the FIHV or holds significant influence, then the provision will trigger.
呢個數字啦。
5B refers to the 20% cap and how this is calculated, and that the beneficial interest of the associate should be taken into account. 5C, as mentioned above, if it's a life insurance company, then the relevant profits will be taken out of the formula because the calculation of assessable profit is based on the 5% threshold. 5D, similarly, irrespective of whether the person has received the money or property, the anti-round tripping provision applies. Page 146, a number of amendments, changing the word resident to person, and then broadening the application. Please wait, Mr. Andrew Fan. Thank you, Chairman. Now, you are amending the word resident to person instead here. According to Cap 1, IGCO Section 3, person means natural person as well as person of any entity. So the word here refers to the entity as well, or just natural person, entity included. Right, Marco. Page 146, amendment to subsection 8. Points A, B, C are the same, and we've added D to G. They relate to the exemptions under UFR and the relevant anti-round tripping provisions. For example, the person is a natural person, the person is an FIHV subject to tax exemption, and then next, life insurance business as mentioned before, and G, interposed entity under different circumstances mentioned before, and 8, capital A, the commissioner may, on application by person, determine whether the person does not have a beneficial interest if he's of the view that in the ordinary course of business have not had a beneficial interest in the FIHV. So, for example, this is an FIHV in the process of winding up of the shares being redeemed, then the anti-round tripping provision will not be triggered. Next, again, a technical amendment changing the word resident to person and expanding the application scope. And then there is a new subsection 10 to avoid double taxation. There are similar new sections put in place under the UFR. If the assessable profits of an FIHV are to be regarded as the assessable profits of a person, and if the person then receives the amount, then that amount will not be subject to double taxation. Page 149, new subsection 11. It relates to appreciation of beneficial interest or increase in value. Again, this will not be subject to double taxation. Page 150. Section 23. Anti-round tripping provision for FIHVs SPE or FSPE. That relates to Section 20AY, and it's highly similar. Again, we add the word etc. after resident persons. Page 151, new 2 capital A, as well as the relevant subsections. 2A, under UFR, there are similar provisions. Here, we're referring to FSPE, and we have relaxed the criteria for tax exemption, and the degree of control of the FIHV will no longer apply as a criterion. So we have put in place some requirements. For example, the anti-round-tripping provisions originally applicable to FIHV will apply to FSPE here. So for the provisions here, they are proposed for the same purpose. That is, for FSPE, they should be subject to the 30% threshold requirement as the anti-round-tripping provision applicable to FIHV. Page 153, new 3A. For subsection 3A, specific anti-round-tripping provision applicable to FSPE to regulate financial institution, insurance company, or group with internal financing activities. To decide whether this provision will be triggered, similar to what's been explained before. So that's about 3 capital A, page 154. 3 capital B is about the 20% threshold and how this is calculated. 3C, insurance company that carries on life insurance business will be exempted. 3D, a new section in page 155, anti-round-tripping provision. Whether or not the person has received or will receive the money or property, the same applies. Page 156, the first amendment relates to changing the word from resident to person. And then under subsection 5, we add subsection 5 capital A. For the purposes of subsections 2B and 3B, now, as mentioned, applying anti-round-tripping provisions to FSPE in 2B and regulating FIs, life insurance companies, in 3B. The extent of a person's beneficial interest in an FSPE is to be determined according to Part 3 of Schedule 16K as if a reference to an FIHV in that part were reference to the person. Subsection 6. The same was referred to in the previous provision, and that is exemptions to the anti-round-tripping provision. So everything stays the same from A to C, except that we have new provisions starting from D. Page 158, subsection 6A and 6B. For the FIHV being wound up, the anti-round-tripping provision will not be invoked. Page 159. A technical amendment from resident to person and application of the provision, the scope will be expanded. Subsection 8 is a new one. Anti-double taxation provision. If a person is distributed with the profits of an FSPE, will not be subject to double taxation. Subsection 9, if there is increasing value of the person's beneficial interest in an FSPE, no double taxation. Now, page 161, we're going to repeal Schedule 16I. Regardless of the extent of holding of the beneficial interest of the FIHV, there will be tax exemption. So Schedule 16I refers to the extent of FIHV's beneficial interest in FSPE, and the whole schedule will be scrapped. Page 165. Section 22 of Schedule 16E, that is the anti-round-tripping provision. Once triggered, how should we ascertain the amount of assessable profit? This relates to Schedule 15C about determination of assessable profits when the anti-round tripping provision under UFR is triggered. And these are similar amendments. I'll go through them. For example, resident person, we have expanded the definition in scope. We've also added another definition of exempted person. We explained how this will apply. Page 166, changing the word from resident to person, and then 3A is a new section. When calculating the amount as assessable profits of a person or beneficial interest of the FIHV, the profits that do not form part of the person's assessable profit should be taken out. Say in the case of a life insurance company, for the life insurance business, the profits obtained should be taken out. And then page 167. Technical amendment from resident person to person. Page 168, the same. Page 169, the same amendments. Page 170, the same amendments as well. Page 171, similar to the previous schedule. This applies to FSPE. So similar amendments. Page 172. Again, straightforward amendment from resident person to person. Page 173. A new section 3 capital A. For the amount in a year of assessment, the calculation should be based on Section 23 of Schedule 16E other than subsections 2A, 2D, or 3A of that section. Then the person's assessable profits should be adjusted in the formula. So 3AA, for profits that do not form part of the assessable profit, such as profit from life insurance business, then the relevant profit should be taken out of the formula. 3B is a new section. It goes from 3B to 3D in the following page for the same purpose. Now, if the investor is a co-investor of the FSPE, and that is the co-investor joins the FIHV in investing the FSPE. In other words, the co-investor does not go through the FIHV. Modifications will have to be made under 3B on how the formula should be interpreted. We went through similar provisions under the UFR provisions. Page 175, Section 7 of the schedule, and then we add a new schedule. That is Schedule 16L, income specified for purposes that do not tally with the tax exemption criteria under UFR. So we set out what the income means, and we set out only one scenario, and that is income derived from shares and stocks of a private company and is attributable to property trading or property development in respect of immovable property in Hong Kong. Legal advisor. Chairman, I invite members to note that Schedule 16L is a piece of subsidiary legislation. Amendments can be made by negative vetting by the Council. For members' information. Thank you, Legal Advisor. Next, last page, 176, new schedule. Schedule 68. How the amendments here will apply to the amendments to the Inland Revenue Ordinance, and it will take effect or apply to a year of assessment beginning on or after the 1st of April 2025. The Bills Committee has completed the scrutiny of the bill. Will there be any amendments proposed by members? And would the members like to consider, like the Bills Committee to consider the amendments? No. Mr. Augustine Wong. Sorry, I may be a bit running slow. I want to ask this question. The Secretariat asked the administration about the effective date specified by the Secretary. Does it mean a delegation of power from the legislature to the Secretary on appointment of effective date? Is a matter of principle. I want to clarify this answer. I don't think the administration provided a straightforward answer. The mic is not on. The way this is worded is this: to be appointed by the Secretary. And this is not an item of subsidiary legislation. So it's not negative vetting by the legislature. The administration already provided a written response. Under the Inland Revenue Ordinance, there is a similar provision that is to be specified by the Secretary. You may recall at the last meeting, we need to consider how the balance is to be struck. About $240 million in value. As explained, the Commissioner also explained the factors considered. And in drawing up the guidelines, they will report to the panel on financial affairs and further elucidate the matter. Would you like to explain further, Francis? Yes. As per the last discussion, I think that there is a clear answer. The administration and the legislature agreed that we need to strike a balance between clarity and flexibility. So having considered the matter, and as explained by the legal advisor, there is a similar approach, and that is for the Commissioner to promulgate the guidelines and publish them on the website. And having considered the matter, we believe that this is the right approach, but as explained by the legal advisor, this is a new arrangement. When the guidance is published on the website, we'll also provide it to the panel for reference. Now, the member asked a very good question. If the Commissioner makes a decision, then it's legally binding. It's not guidance in nature. It's not opinion. That way, in relation to Articles 62 and 73 of the Basic Law, I want to know whether there is any conflict, because it's for the administration to table a bill. And then Article 73 of the Basic Law provides that this power lies with the Legislative Council. So I want to make sure that this is in line with Article 62 and 73 of the Basic Law. Now, I am not against the Commissioner's practice of publishing guidance on the website. I just want to know, as a matter of principle, whether this is all right. Francis, in making this decision, we have sought advice from the Department of Justice. So members can be reassured. Anything from the administration or from the DOJ? Nothing? Mr. Augustine Wong, anything to add? No problem, as long as this is confirmed. Legislative timetable. The government plans to submit or resume the second reading of the bill in the second half of 2026. Once the bill's examination is completed, the administration will inform the Council of the proposed date of resuming the second reading of the bill. As for written submissions, the administration will provide a written response in due course. The administration will also be submitting the draft CSAs if necessary. Once received, the Secretariat will circulate them to members, and by then I will consult members and see if there is a need to call for another meeting to discuss the written response. If there's nothing else under AOB, then meeting's adjourned.